All right, let's talk about something that too often gets stuck in the compliance bucket, when really, it's our single most important strategic scorecard. I'm talking about capital ratios. And no, this isn't about just checking boxes for regulators. This is about one thing: measuring our strength and our freedom to make big moves.
This quote, it absolutely nails it. See, our capital position isn't some dry number on a spreadsheet. It's a statement. It's us telling the entire world, investors, regulators, everyone, exactly what our appetite for risk is and how serious we are about our long-term vision.
Okay, here's how we'll tackle this. First, we'll look at the idea of the capital fortress. Then, we'll flip the script from compliance to competitive advantage. After that, we'll see strategy in action with a real-world example. And we'll wrap up with the red flags you need to watch for. Let's get into it.
All right, part one, the capital fortress. I want you to think about our bank's capital, not just as a pile of cash, but as a medieval fortress. It's not one big wall, it's a series of layered defenses, each one designed to kick in at just the right moment of stress.
So, the heart of that fortress, the keep itself, is our Common Equity Tier 1 capital, or CET1. This is the good stuff, our purest form of capital, mostly common stock, and our hard-earned retained earnings. When the first arrows start to fly, those unexpected losses, CET1 is what takes the hit, keeping us standing and in the fight.
Then you have the next wall, which is our additional Tier 1 capital, or AT1. Think of this as the reinforcements. It's often made up of things like perpetual bonds. And here's the really clever part. If things get truly hairy, this capital can actually convert into common equity, shoring up that innermost wall right when we're under siege.
And finally, the outermost wall of our fortress. This is Tier 2 capital. Now this is what's called gone concern capital. Things like subordinated debt. To be blunt, this is the layer that protects everyone else, our depositors, our senior creditors, if the absolute worst happens and the fortress falls. It's the failsafe.
So, if we look at them all together, you see the brilliant design, right? You've got CET1 as the core, absorbing the first shock. AT1 is the quick reinforcement. And Tier 2 is the final line of defense to protect others. Every single layer has its job, and they all work together to make us resilient.
Okay, this is maybe the most important slide in this section. Regulators tell us the absolute floor for CET1 is 4.5%. But let's be real, that's not the number that matters. The strategic reality, once you add all the required buffers, is more like 7%. Dipping below that number means regulators start telling us what we can and can't do. So, aiming for the minimum? That's not a strategy, it's a trap. Our goal has to be living comfortably above that real floor.
All right, part two. We've got the fundamentals down, now for the fun part. Let's talk about how we stop thinking about capital as a boring compliance task and start using it as our primary competitive weapon. This is about turning data into dominance.
So many banks make this mistake. They look at peer data from 3 or 6 months ago to plan their next move. Seriously? That's like trying to win a Formula 1 race by only looking in your rearview mirror. By the time you see the other car, they've already passed you. It just doesn't work in a market that moves this fast.
And this isn't just theory. Let's zoom out and look at the G7. After the '08 crisis, U.S. banks got serious about building up capital. Look at this. By 2021, the average Tier 1 ratio for U.S. banks was 8.5%. The next closest G7 country, Italy, at 6.1%. That huge gap isn't just a number. It's a strategic advantage. It means the entire U.S. system is more resilient, more ready to act.
So what's the solution to that rear-view mirror problem? It's this: dynamic, real-time benchmarking. Instead of looking at old data, we compare ourselves to our true peers, right now. The second we do that, capital stops being a history report for the feds and becomes a live dashboard for beating the competition.
Okay, part three, capital strategy in action. Enough with the theory. Let's look at how this plays out in the real world. It's situations this very board has to face, where these numbers either give us the green light or a hard stop. Here's the classic boardroom question, right? We've got a potential acquisition on the table, but will it torpedo our capital ratios? This is where capital isn't just a number, it's the main character in the story. Let's run the scenario. So let's say this is us, Bank A. We're starting out strong. Our CET1 ratio is a healthy 12.5%. We've got plenty of firepower, a solid buffer, we're ready to go hunting for opportunities.
And then Bank B comes along. It's a great strategic fit, but there's a catch. Their loan book is packed with assets that are a bit riskier than ours.
And what does riskier mean in this context? It means higher risk-weighted assets, which is going to directly impact our ratio.
We run the numbers and boom, post-acquisition, our CET1 ratio drops to 11.2%. Now hold on, we're still well above the minimums, right? But look what just happened. We burned through 130 basis points of our precious capital buffer on one deal. That's less dry powder for the next opportunity. It's less cushion if the economy takes a nosedive. That's the real cost.
And look, this isn't just about M&A. Every single big decision we make has a capital consequence. Want to shift into riskier, higher-yield loans? It eats capital. Want to do a big share buyback? That eats capital. Our job, as a board, is to be absolutely ruthless in analyzing these trade-offs. Every move is a choice, and every choice impacts our resilience.
So that leads us right into our final section, early warnings, decisive action. The big question is, how do we make our quarterly reviews a tool for looking forward, not just a report card on the past?
I mean, what's the one thing every board member wants? To see around the corner, right? So what are the red flags? What are the subtle signs that tell us our capital position might be weakening long before the headline ratio starts to drop?
Okay, here are 3 big ones to put on your dashboard. First, are our risk-weighted assets growing faster than we're earning money to support them? That's a huge red flag. Second, are we seeing consistent operating losses, even small ones? They're like a slow leak in your capital bucket. And third, are we putting too many of our eggs in one basket, rising asset concentrations? If that one sector goes bad, it can take a huge chunk of our capital with it.
So, the bottom line is this. From now on, our quarterly capital review can't just be us passively listening to a report. No way. It has to be an active, strategic debate. It's where we ask the tough questions about funding our growth, managing our risks, and delivering returns for our shareholders, all viewed through this powerful lens of capital.
So, I'll leave you all with one final question to think about. Is our capital just a defensive shield we're forced to hold up for the regulators? Or is it the sharpest weapon we have to win in the marketplace? How we answer that question as a board will define everything we do from here on out. Thank you.